Hello learner, welcome to Manifested e-learning forum. This is Equity Investment Analysis. We are looking at overview of equity securities, lesson 3. And what we looked at in lesson 2, I can just recap very briefly. We start with the overview of equity securities. What we looked at in lesson 2, we looked at the types of equity securities. Types of equity securities. Then we went ahead and looked at the voting rights of equity securities. There. What we are going to look at in lesson 3 includes the private versus public equity securities. Yeah. Then we will move ahead and look at the risk and return of equity securities. Then we will conclude this lesson by looking at the market value and book value of equity securities or of assets. There. So this we covered, that we covered in lesson 2. Now these 3 is what we need to cover in our lesson. So we start off by looking at private versus public equity securities versus public equity securities. Yeah. Now, private securities are the ones which are, or the types of securities which have been issued by private entities. The public are the ones which are issued by publicly listed firms, or the securities which have been issued at the stock exchange or at NSE. So they are public because those shares are available to any ordinary individual outside there. So if you want to buy shares of a publicly listed firm, you can be able to just walk into a stock brokerage firm and an investment bank, and you are able to access the shares of, say, KCB or even Equity Bank, like that. Public, they are available to the public. Private, they are available to private individuals, or they are not listed. Private companies tend to issue shares through private placements. So I can put it over here in writing down and say that private equity securities differ from public securities, equity securities, in that they are issued to private individuals through private placements. Private placements. On the other hand, we are saying that public equity securities are issued to the public through IPOs, investment or initial public offering. So we say public equity securities are issued to the public through an initial public offer, IPO. That. As well, private equity securities differ from public equity securities in that the private equity securities are less liquid, because private placements issue securities to private individuals through a closed kind of offering. Than IPO is different in that shares are issued to the general public through an IPO. Yes. So we say private as well. Let's say as well as well private equity securities differ from public equity securities in that the shares are less liquid. If you want to buy the shares of publicly or private equity securities, you cannot be able to just go to the general public and ask them for the shares. You have to go to the specific company that has issued the private security and try and identify whether the shares are on offer. For example, if we have a farm, I can come over here, and if we have, say, Old Mutual, UAP, Old Mutual. Company called UAP Old Mutual is a private company. The shares are not listed on the exchange. If you want to access the shares of UAP Old Mutual, you have to go to UAP Old Mutual and ask them, the securities section, you ask them if the shares of UAP Old Mutual are available for purchase. Chances are that you might find them or you might not find them there. But if you don't find them, you have to wait until the shares are available for UAP Old Mutual. So in terms of accessibility of the shares, it becomes very difficult. Compare that scenario with the scenario of KCB. The shares of KCB are readily available because these shares have been issued to the public through an initial public offering. KCB shares, if you want to go and buy them, you just need to open a CDS account or Central Depository System account, and then you can be able to now access the shares. If you want to buy 100,000 shares, by the end of the day, when the market closes at around 3 p.m., you will be able to access the shares of KCB. That's how liquid public shares are as compared to private shares. So I'm saying as well, private equity securities differ from public equity securities in that the shares are less liquid. So I can put it in brackets, private equity securities. Like that. These are for private equity securities. That's what I'm saying, that they are less liquid for private equity securities. For public, I've just explained that they are more liquid there. Now, how private shares or private equities, private equity differs from public equities are in three forms. The types of private equity issues include, I'm going to come on here, say the types of private equity include the first type. We have venture capital. So under venture capital, we are saying that these firms are given seed financing, or they are provided for financing so that they can be able to try and take the company to the next level in terms of profitability, in terms of revenues, and also in terms of market share. So if they can be able to demonstrate these venture capital firms as a type of private equity occurs when the company is at this level and it grows to this level like that. The seed financing can come from outside, both in form of equity and in form of debt. Seed financing. So both in form of equity and in form of debt. So you can put equity versus debt. That equity and debt. You can say and debt. Once you provide the seed financing at this stage of a year, it should be able to take the company to become that size, and maybe even later it can become a very big company like that. That is what we're saying is venture capital financing or venture capital type of private equity. So put it in writing, we can say that it provides seed financing. Venture capital firms, or V, can put in these brackets, VC firms. VC, venture capital firms, are provided with seed financing in order to invest in productive activities so as to grow in market share. Also grow in capital expenditures, capex, and capital expenditures, and maybe say we can be able to say research and development. There. That's the first type of private equity. So they usually receive seed financing so that now they can grow the firms in terms of assets, and it could be able to also grow in terms of research and development as well as capital expenditures there. The second type of private equity is leveraged buyout. Under leveraged buyout, investors go and borrow funds from a company so that they can be able to invest or rather, they go and borrow money from a commercial bank, and then they come and provide that financing, or they go ahead and buy out a company through the use of debt. So we say that leveraged buyout, in the leveraged buyout, investors take up loans which are used to purchase companies. That if the company's management go ahead and buy out a company, that kind of buyout is called a management buyout. So we say if the buyers of a company include the company's management, we can say that the buyout is a management buyout, which you are saying is MBO. This one, a leverage buyout, is, we can say, an LBO. You go ahead and take debt, you go and borrow from a commercial bank, you invest in a company and buy out and use the proceeds from that company to finance the loan. In a management buyout, if the company's management have got sufficient funds, they go ahead and buy out the company, and it's called a management buyout. The third category of private equity investments is private investment in public equity. Number 3, private investment in public equity. Private investment in public equity. So what happens is that a public entity issues shares to the public in a private basis. So we say that a public entity issues shares through a private placement to private individuals. That. So we are saying that a public entity over here, public, floats shares to the public, that, so that now the public can provide the financing back, KSHS, that, which now the public entity can now go ahead and invest in CAPEX, capital expenditures, marketing, research and development, R&D, amongst other things. That is what we're saying is a private investment in public equity. Yes. So that just clarifies the three types of the third type of private equity investments. Now we have looked at the private versus public equity securities. There, you can take that. Now we can move on to this other subsection where we will look at risk and return of equity securities. Risk and return of equity securities. Risk and return of equity securities. Now we start off by looking at the return of equity. There. So we're trying to identify the components of return, or the components that provide return in equity securities. The first component is dividends. We are saying that each investor wants to get at least every year some form of return on investment. And the first form of return on investment is dividends. Dividends are paid at the end of every financial year for companies or out of the company's profits. If it's a dividend paying firm and there is a very lax dividend policy or favorable dividend policy, we can say that that company can pay out dividends annually. There. The second form is based on capital gains. Supposing you bought KCB shares today at 56 shillings. At the end of the year, the price rises to 100 shillings. The difference between the price which I had actually bought it at and the price which I'm going to sell it out provides a gain. And that gain is what we're saying is capital gains. So I'm saying this is KCB share. I bought it at 56 shillings. And at the end of the year, I sold it, it was 100 shillings. That, for example. So the difference between those two is 100. You get the wealth at the end. Let me just write the formula. The wealth at the end minus wealth at the beginning over wealth at the beginning, like that. That is what you're saying is capital gain. The value at the end, the value at the beginning over the value of the beginning. It represents a percentage. So we say it is 100 minus 56 over 56 there. And we can very quickly compute the rate of return there. This is 100 minus 56 divided by 56. The rate of return is 78.5%. 78.5%. That means that the share price has actually appreciated 78.5%. That is the second component of return. Now, if you invest in equity securities abroad, the differences in exchange rates provides an opportunity to get a level of return. So that is when you invest in foreign equity. So we can come here and say the third component of return third component of return is differences in exchange rates. 3. Differences in exchange rates. Differences in exchange rates. Now, if, say for example, the Kenya shilling has actually appreciated by almost, or maybe you buy the shares, this is Kenya and this is Uganda. You went ahead and bought the shares in Uganda. Of course, you have to have an exchange rate between the Kenya and Uganda shilling like that. And at the point when you bought the shares in Uganda and realized some form of gain, when you come back and translate or convert it back into Kenya shillings, and you realize again, there is what you're saying is an exchange rate gain. Exchange rate gain. And that is what I'm saying, the differences in exchange rates like that. So if you have an exchange rate gain, then it is positive or it's something good to the Kenyan economy, because you're saying that you've actually benefited by investing in Uganda. Yeah. So that means the shilling, the Uganda shilling is weakening, the Kenya shilling is actually strengthening there. So those are the three forms of return of equity securities. The first one is dividends. The second one is capital gains, the differences in the prices or in the values of investment. And then you're saying the differences in exchange rate provides the third form of return. Now we look at risk. Remember, the topic is risk, or the subtopic is risk and return in equity securities. So risk of equity securities. Risk in equity securities is quite simple. So you compute risk using standard deviation. So risk in equities is computed using standard deviation. So the standard deviation, say it depends whether you're looking at standard deviation of a portfolio. We can be able to just write the formula very quickly over here of how we can be able to compute the standard deviation. So we write standard deviation, or SD, is given over portfolio is given as, the formula is as follows: the weight of 1 squared, standard deviation squared 1. This is the weight of first security. This is the standard deviation of the first security. This, of course, is just a brief synopsis of what you'll be able to cover in portfolio management. Then you add the weight of the second security, standard deviation of the variance of the second security, plus 2 covariance, 2 times the covariance. Then you have weight of 1, this is times weight of 1, weight of 2 there. That is how you can be able to, that's how you compute the risk and the risk of equity securities as far as a portfolio is concerned. So this will be demonstrated or will be explained to in more detail when you're looking at portfolio management, and I'm sure that this will be very common when you'll be looking at portfolio management in trying to compute the risk of, say, a portfolio, the risk of one asset, and so on and so forth there. Now that we have looked at risk and return of equity securities, tick that there, we will conclude by looking at the market value and book value of assets, this subtopic. In the market value and book value of assets or of securities, we just need to know how to compute the market value, or the definitions of value, market value and book value will be highlighted. So market value and book value of assets. Now, or when I say assets, I of course obviously mean securities there. So we'll first of all begin by defining what a book value is. So A, book value, Book value is just the value of the assets minus the liabilities. Put it briefly, in the statement of financial position, the balancing figure there is what we are saying is the book value of assets. So, is the value of assets minus brackets less the value of liabilities. That. B is market value. When trying to explain the market value, it is the number of shares multiplied by the market price per share. All shares which have been listed in the securities have got number of shares which they've actually floated to the market. Once they floated that to the market, we can take an arbitrary day, an arbitrary point, say for example last week Friday's closing price. Last week Friday's closing price, all of the securities have been listed like that. Let me just try and demonstrate it so that you can be able to drive the point home. So these are the securities which have been listed on the exchange there. 65 companies. We have the market price as of last week Friday given to us there, just besides each security there. Then we have the number of shares outstanding. That the number of shares outstanding means the number of shares that company or each company in the exchange have actually floated the shares to the exchange, either most probably through an IPO. So we have them there given to us like that. Now, market value is simply the market price times the number of shares outstanding. So we can say here that the market value, if we put this in terms of columns, we can say this is column A, this is column B, column C, and column D. So can we say that column D is given as column B times C, or the product of column B times column C there. So we have the market values given to us there. Another term for market value is market capitalization. So all the shares must, or every week, the market capitalization is usually provided there. The summary of the NSE's market capitalization is usually provided on the NSE website. In fact, a daily market capitalization, if you go to the NSE's website, you will be able to be provided with the daily NSE market capitalization. You may also get the market capitalization based on the daily price list that is posted on the NSE's website. So the market value, you can put it in form of words. Say that the market value is the product of market price and the number of shares outstanding. Now, once we have the book value and the market value, we can be able to also determine the price to book value. So the price to book value is just the market price per share divided by the book value per share. And we've already defined what the book value is. It's just the assets minus the liabilities. And now, since you have the book value, you now divide the book value by the number of shares outstanding so that you can get the book value per share. So it's the market price per share divided by the book value per share. That. So now that we have looked at the book value, the market value, the price to book value, let's look at how we can be able to compute the return on equity. So the return on equity, we have a short subtopic here, return on equity. Simply put, ROE is given as net income divided by the average book value. That. We can now just summarize that and say NI divided by book value 1 plus book value 2 plus, we can extend that a bit, say book value 3. If you've got say 5 of them, you just get the average of that. So you just put it in brackets like that, divided by 3. Or if there are 5 of them, you put it divided by 5. So that's why we are saying it is the average book value. That marks the end of the market value and book value of equity securities and assets, or assets there. Before we conclude this topic, I have an assignment for you. Assignment reads as follows. Given the figures below of O company, calculate the return on average equity for 20x9 and the total market value of equity, the book value per share, and the price to book value ratio at the end of 20x9. Thank you for joining us.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.